Hi, this is Tom Sedlak, General Manager at 33rd Company Property Management. Thanks so much for taking time out of your busy day to watch this podcast on how HOA boards should use their reserve funds. Generally speaking, HOA and common interest communities will maintain two separate accounts for their operating funds. One is a reserve account and the other is an operating account. Reserve funds are specific capital improvement funds that are segregated into a reserve account and are used only for those capital improvement or large repair projects. Operating funds are the day-to-day funds that are used for utilities, minor repairs, trash, insurance, and all of those day-to-day expenses throughout the year to keep the HOA operating normally. State laws generally regulate how and when HOAs can remove funds from reserve accounts. It's generally a requirement to have an earmarked capital improvement first before removing funds from a reserve account. So you want to wait until you actually have a quote from a vendor, you've voted and approved the capital improvement before you take funds out of the reserve account and move them into your operating account in order to pay that particular vendor. HOA managers typically put together a reserve study showing the amount of estimated capital improvements and costs allocated into the out years so that it's very clear from the reserve study that sufficient long-term planning for such capital improvements is being done responsibly. 33rd Company does put together a 30-year detailed reserve study for our HOA members. It's actually a spreadsheet-based HOA study that's very comprehensive. The top of the spreadsheet typically starts out with a column for each of the years going out to year 20 and then 5-year increments out to year 30. Then you have the income. The income is all of the member dues and any other residual income that you will be getting from your HOA that supports your operating and reserve cost accounts. Below the income are your expense lines. You have all of your regular operating expenses as well as rows for your reserve account expenses for capital improvements. And then typically below that there's a summary line that shows the balance between your income and your expenses and whether you're positive or negative. It also shows any allocations from excess operating revenue going into your reserves, and then it shows both your operating bank account and your reserve bank account. And what you want to do is you want to put all of your expenses, your recurring expenses, into the operating side. You want to escalate those at a typical 2% per year. Then you also want to put in your extraordinary capital improvement expenses in the appropriate years where they belong. For instance, if your roof is expected to have maybe 5 more years of life left in it, in year 5 or possibly year 4, you may want to have a plug for a roof replacement. And that plug needs to be supported by the revenues that are coming in through that period as well as the account balances at that time when that roof expense is going to be experienced or exercised. And so the practice then is to plug in all of those extraordinary reserve expenses, roof, siding, window replacements, any concrete repairs, any large capital improvements over the next 30 years that you know are eventually going to have to be made. Those need to be plugged into the appropriate years. And then the exercise then is to look at your net operating reserve accounts and see if the balances support all of the day-to-day operating as well as the long-term reserve costs. And if they don't, you've got a few options. The first option is to simply raise the dues. It's instead of a 2% escalation for your annual dues, maybe try a 3 or 4 or 5% escalation and see if that fills the gap and prevents your accounts from going negative, for instance, in year 10 or 9. Once you've done that, if that's insufficient, another option for you is to consider a special assessment. Special assessments are not generally well received. It's an indication of poor planning. It's an indication that your HOA manager didn't properly foresee upcoming expenses or capital improvements, and typically it's not well received by your constituency either. Generally, members are going to be a little put off if they are asked on short notice to put up a $3,000 assessment for a roof replacement because the member dues are not adequate to cover that expense. So this is why it's very important that you do map out a very detailed reserve study to help avoid having special assessments, because they can also lead to litigation. Your last option, if special assessments are not perceived as viable, is to take out a loan. Some banks, especially smaller local banks, will offer loans against member dues. Sometimes they will put a lien on the physical property to facilitate a loan. Some banks are willing to not put a lien on the actual property. They're simply putting a loan against the receivables that are stipulated by the HOA. Either way, you're going to be paying interest. The cost of the repair is going to be higher because of the loan and the interest costs, but nonetheless, it'll help avoid a special assessment. It'll help your members budget their own personal dues payments, which now will probably be higher because of the loan, and it'll help them avoid getting a surprise special assessment and triggering litigation. So those are typically the options that boards have when using reserve funds. It is very important, though, that the boards have good documentation, and by that we mean that they need to have very well articulated minutes. They need to have documentation for votes for incurring reserve activities, capital improvement activities. They should make sure that they're authorized to do such things under their governing documents, and that includes the declarations as well as the bylaws and the rules and regs. And they also need to communicate. Probably one of the biggest issues is communication, making sure that all of the members are heard, that the type of improvement, the timing of the improvement, and the cost of the improvement is well communicated to all of the vested stakeholders in your HOA community, to make sure that everyone is on board to take care of such a reserve activity. 33rd Company has been in business for a long time, helping boards to properly put together reserve studies. We have an extremely detailed spreadsheet that helps you do what-if analysis and can determine exactly where your dues increases or your loans or assessments can be applied to very strategically craft your cash flow so that you can meet the ebbs and flows over that long-term period and not have a gap or an issue in your cash flow through your reserve study. For more information on HOA and CIC reserve funds, please visit our website at 33rdcompany.com or contact one of our experienced HOA managers. We'd be happy to help. Thanks for listening.